Welcome to Side Effects. Effect versus affect. It's hard to know the difference. At McGohan Brabender, our goal is to provoke you to think differently about employee benefits, your employees, and the status quo. That's why it's Side Effects with an A. Join me, Kenzie McEvily, an MB co-host and one of the industry's brightest guests to dive deep into the process of good employee benefits. Let's get started. Today on our show, we welcome Pim Jager, the Vice President and Captive Practice Lead at Scott Insurance, headquartered in Richmond, Virginia. Pim has over 25 years' experience in human resources administration and benefits consulting, and partners with captive organizations to implement a clear strategic vision for their employee benefits programs. He's an expert in all things employee benefit related, but we specifically asked him to be a guest today to share his expertise on the topic of captives. Captive insurance is an alternative to self-insurance, in which a parent group or groups create a licensed insurance company to provide coverage for itself. Sounds too good to be true, right? Pim guides organizations to discover the best fit funding mechanism for their employer-sponsored health plan, including alternative financing such as self-funding or group health captives. In this podcast, we will learn more about the origin of captives, the community they have created, and how they've evolved in the marketplace. Without further delay, welcome Pim to the show. Hello, everyone. Anne-Marie, thank you for joining me as a co-host today.
Yes, thank you for having me, Kenzie.
And Pim, welcome to the show.
Hi, Pim.
Hey, thanks for having me. Great to be with my friends from McGohan Brabender.
Yes, and we are tapping into, once again, our C2 Solutions partners. Pim, we're so glad to have you today. And this C2 Solution partnership, it's what it's all about, right? To have you on the podcast, get your expertise, and just chat a little.
Yeah, it's definitely the spirit of our collaboration. I think, very clearly on display, and excited to be able to live into that here with sharing hopefully some good information for you and your clients about captives, obviously.
Right. So in my intro, I gave a brief definition of what a captive is, but can you break it down further for us? What are they, and how do they fit in on the benefit spectrum?
Yeah, so I'll try to do that without getting too complex, obviously. But essentially, at the core of it, a captive is when self-funded employers come together to share a layer of risk, a predetermined layer of risk. And normally the goal of sharing that layer of risk is to essentially create a larger pool to absorb large claims that will occur in their population. But these large claims tend to be claims that are volatile, meaning we don't know when they're going to happen. We don't know how large they're going to be. And if you're self-insured on your own, one single large claim can be really disruptive, both financially and just structurally to your plan. And so when members can come together and share for the risk of those large unpredictable claims across a large aggregate group, it essentially creates a shock absorber. And that shock absorber creates, obviously, benefit for all of the members. Right. Secondary to that is that captives also create an opportunity for return of funds when we perform well. So when we create this pool or shared risk, we all pay premium in to cover those claims for that shared risk. But when we perform well and do better in managing our risk, then we're able to take what is left in that pool and distribute it back to the members in the form of dividends. It's essentially like taking profit from what would be a traditional insurance contract and being able to return it back to members.
Yeah, and employers certainly love that option and that opportunity. So talk to us a little bit about how long has this captive structure been around? I mean, I've been in the benefit space coming up on 16 years. And when I first, came into the space, we didn't hear a lot about these group captives or employer captives. So how long has this structure been around? And when did it really start to pick up steam or become a more common option as we know it today?
Yeah, that's a really good question. So maybe take us a step even further back, right? Captives in general as kind of an insurance structure really, were founded in the 1950s or so, but they were focused on different types of risk, liability risk, workers' compensation risk, those types of things. So health insurance, if we're talking specifically about health insurance, the health insurance programs didn't really start to emerge until the late 80s, early 90s, but then it was generally in the format of really large employers using captives to self-fund employee benefits like life insurance and disability insurance programs. What we're probably going to talk more about today, and what's probably more relevant to our listeners, is group health insurance captive programs. And those really got jump-started, from my perspective, with the passage of the ACA. So the ACA really changed the way that health insurers could and do underwrite organizations. And it created an environment where mid-sized companies that were still fully insured and were performing well in the fully insured market because they had better demographics or were their claims were performing well, they were no longer seeing the benefits of that good performance in their rates and their underwriting practices of the insurance companies moving forward. The other thing that happened with the ACA too were these insurance industry fees that the ACA implemented. And so all of a sudden what we had was a lot of mid-market companies that were looking at their insurance world post-ACA and saying, well, if we no longer benefit from our positive experience in a fully insured pool, and we're having to pay these additional taxes for the privilege, so to speak, of being fully insured, then we really need a way out. And so for a lot of them, captives became a viable alternative because it gave them a way out of the fully insured market, but without all the risk and volatility that would come along with doing that on their own as a single self-funded health plan.
Yeah, and you're saying ACA, and for us it seems like perhaps just yesterday, but even for some of our listeners, they may not have been in the workforce when that was passed, March 23rd, 2010. So over 11 years ago now. Hard to believe.
Yeah, and so that date, sticks with me because we really kind of rallied our resources and investigated options for our clients who were asking for a different solution. And so we actually launched our first health insurance captive here at Scott in July of 2011. So we were able to rally a pretty quick response, I think, because it was, something clearly that our clients, needed and continue to, obviously.
Mm-hmm. Wow. And I know one of the main points of this podcast is to talk about the evolution of the captives, and the ACA was a huge part of that. But Pim, can you kind of talk about how it's evolved over the last few years regarding the employee benefit healthcare captives?
Yeah, I think that when we talk about the evolution of captives, right, probably the biggest thing to point to over the most recent years has been that there's a diversity, I think, of captives that are available. So there is a captive, health insurance captive out there for lots of different types of organizations and structures. So what I mean by that is that there are some captives that are industry specific focused. There are some captives that are based upon associations or other affiliations. And then you also just have, general, group heterogeneous, programs as well, too, that are just trying to bring together, high performing organizations. So one, I think, thing that we're seeing obviously is the diversity. And then two, the other big change that we're seeing that I'm sure we'll spend a little bit of time talking about is that we're starting to see more and more companies that are already self-funded look to the captive as an alternative to being self-funded on their own. So in the past, I would tell you that 90% of the organizations I spoke to about captives were fully insured, looking to make a transition, right, and dip their toe in the water of self-funding. What we're seeing now is that closer to, probably 30-40% of the groups we're talking to are already self-insured. They're looking just for a better way to be self-insured.
Right. And so I'd like to dive a little bit deeper into that. But just before we do, I know you're trying to get your light to come back on.
There we go. Trying to get my lights back on. Sorry about that.
That's okay. Oh, that's so awesome. If we could just take one step back before we go a little bit deeper into, a stop loss captive or a health insurance captive, And, we hear oftentimes when we're talking to employers, oh, yes, I'm in a captive today. And maybe they're talking about their property casualty relationship or captive, or they're like, oh, yes, we use a captive, as a tax strategy. So, we don't need to talk to you about this health insurance captive. So maybe talk to us a little bit about the types of captives that are out there and delineate why this is different and specific.
Yeah, so generally, a captive at a 30,000 foot view level is essentially the same across the different types, right? There's always the concept that you are paying for your own losses or self-funding your own risk up to a certain level, and then sharing a level of risk. And then above that, you're still, as a group, purchasing some level of pure insurance, whether we call that excess layer insurance in the health insurance side, or whether you call it an umbrella policy in some other types of captives. Mm-hmm. So the main tenets remain the same. Some of the products, the most popular products that you see in captives outside of health insurance are definitely general liability insurance, auto and fleet insurance. Workers' comp is one as well too. And then also some other unique programs like warranties. Oftentimes companies that have a large warranty risk, right, mm-hmm. will fund those in a captive model, both for the tax advantages, right, and the long-term, ability to drive down expenses for those. So those are some, examples of the different types of captives that people, may already be in or have heard of. One of the big, though, differences between health insurance captives and those other types of captives is that our health insurance captive is unique in that it covers a known liability over a much shorter period of time than other captives do. Mm-hmm. And the reason for that is that in our health insurance world, right, we are insuring contracts that generally cover a period of 12 months of incurred claims, and then sometimes we're covering, right, some run out months to make sure that we're capturing that claim that was incurred in the contract period and then not yet paid out. But in general, right, we can identify what our total liability is in any given contract year within 2 to 3 months or so after the end of the contract, because those health insurance claims have to be paid on time. There are prompt pay provisions that exist with the providers. So we don't have any significant long-term liability in a health insurance captive like we do in other types of captive structures. Why is that important for folks that are listening and thinking about health insurance captives? Well, it means for them that two things. One is that they're able to see the benefits of dividends returned back to them as members in a much shorter period of time. Generally, we're returning dividends back to the members within 9 to 12 months of the close of the plan year. And two, it also means that if they decide that the captive structure isn't right for them, or they're acquired, or there's another, something else happens within their organization that leads them to need to leave the structure, they don't have ongoing significant liability right to the captive. So they can exit the captive easily. Yeah, you mentioned it, right? There's no long tail. The tail is much shorter. So if they need to exit, right, that's a much simpler and less arduous process than other captives present.
Yeah, and that's one thing that in talking with employers about considering a health insurance captive, if they've had experience with a property casualty captive and it happened to not be a good experience, that's generally what they remember, is not being able to exit that arrangement. So thank you for pointing that out. So you mentioned earlier, and you started to talk about this, and I pulled you back up into the bigger world. But what type of employer is a good candidate? And you started to talk a little bit about the fact that it used to be fully insured employers, and now it's including employers that are self-funded on their own today. So if you could describe some key characteristics of employers that might be a good fit or may want to explore looking at a captive arrangement.
Yeah. So generally, historically, we've we've cited size of an organization as one of the key factors, right? The companies that have historically looked at themselves and said, hey, we're too small to self-fund on our own or to self-fund comfortably on our own. And so we want to be part of a captive to have the protection of the other members. So generally, historically, we've said roughly 50, 60 employees on up to 500-600 employee lives as being kind of that target for those groups. But I would say that, with the fact that we are now seeing more self-insured groups, looking at this, the employee count no longer really resonates, I think, as much, or is not as much of a primary factor. I think, honestly, the thing that we look at more is what's the intentionality of the group to try and better manage their risks so that they can be rewarded in the long term for better managing that risk. And when we're talking about health insurance, it's pretty simple, right? What are we talking about? We're talking about how do we help our employees and their families have better access to really high quality care at lower cost? How do we give them the tools and resources to live better and healthier lives, to proactively manage chronic conditions, all of the things that at the end, really come back to influencing, the 80 cents of every healthcare dollar that is the claims that we pay, right? The services that we use. And so we really look now at captive prospective members in a critical way to say, are you willing to be part of this collaborative community of these other companies that are really focused on not just enjoying the financial structure of a captive and the protections of the captive, but are you willing to be an active member in this community to help us better manage the risk that we share and create better outcomes for your employees and their families?
Yeah, so a shared philosophy towards managing that and providing for their employees. And it brings also the opportunity for some of these employers to take advantage of programs that they may not have otherwise been able to obtain on their own individually, right? So some of
that's a really good point. And in my opening about what is a captive, right? That's probably would be the other item that I would add on to it. That successful captives foundationally provide a way for smaller employers to use their aggregated size to access resources that they otherwise wouldn't be able to access on their own. And that's just a marketplace reality for us, right? We all consult also with large employers that have thousands of employees, and they are, to kind of use an anecdote, right? They're able to pull all these different levers from a healthcare perspective to try and influence cost. And when we can use the captive as an aggregator to give our clients the same access to those types of tools that Fortune 500 companies enjoy, boy, that's when we can really make an impact.
And Pam, I remember on our pre-call, we chatted a little bit about captive managers, and that was something I found interesting. What exactly is the role of a captive manager, and kind of how are they so necessary to make this successful?
Yeah, captive managers are really a key part to the success of any program. I think of the captive manager as really being the hub for the program and providing, the hub of core services to coordinate administrative services, to coordinate for the collaboration and to facilitate interaction between the members, whether that's quarterly calls, whether that's education sessions, whether that's annual meetings. And then also, very importantly, to make sure that we are in compliance. At the end of the day, a captive is still a filed entity. It needs to be domiciled and filed appropriately with a Bureau of Insurance. Most of our programs are domiciled in the state of Montana, but they can be domiciled both in other states in the U.S. as well as internationally, depending upon preferences. And so all of that is really important functionally, to make sure that you've got a captive manager that, really has the best interest of all the members at heart and is aligned with that membership's goals and objectives.
And I think collaboration is an excellent word for this podcast. And the community aspect of captives is pretty cool, I think, too. Can you kind of touch on what do companies get out of this when they're a collaborative community together?
Yeah, collaboration is absolutely the key. And one of the phrases I use a lot when speaking to captive members is, are you prepared to put the we in front of the me? Because there are times when you're going to be asked to do that as a captive member. But the key, I believe, in all of this is that if you join a captive with the appropriate intentions, you're going to take more away from the other members in areas of best practices, ideas, inspiration, accountability than you put into it. And that is really key. Collaboration doesn't go very far if there isn't accountability as well too to that collaboration. So things that we do within most of our captive programs, for example, is to set what we call standards of excellence, or sometimes they're community best practices. We use different phrases for them in different captives, but the idea there really being is, hey, let's hold each other accountable. Let's leverage the power of some peer pressure to say, hey, are we really all doing our best to create better outcomes, not just for ourselves, but for the broader community?
Yeah, that's really helpful to hear. And so I think I know the answer to this question, but I'm going to ask it anyway, as I want to hear it in your own words. So talk to me about your opinion in terms of the future and the longevity of captives. They really rely on this curated community and this collaboration. What do you see happen if that doesn't exist? And do you have an example of maybe when it worked really well and when you've seen it not work really well?
Yeah, I am very bullish on the future of captives, because I think that the fundamental concepts of both the financial structure and this idea of collaboration with peers are just tenets that are going to remain very solid, for us, regardless of the environment, that we are in. And it's really just one, I believe, of getting the message out and communicating, these values appropriately. To me, most of the time, it's not about, our captives growing because there are people like folks at Scott Insurance and McGohan Brabender out there promoting captives. I think when we grow is when we are out there talking about the message and we find the companies that have been asking for this solution all along, right? Those are the best moments, and the best success stories are when we are able to sit down with a leadership team at a company and start to describe the philosophy behind captives and how they work and how they operate. And a member of that team or several members of that team will just look at us and say, well, I've been asking about this for years,
right?
And everybody was telling me it didn't exist, and now you're telling me that it does, right? So I really do feel that we're going to continue to see, significant, growth, just because it's something that people want and are looking for.
So speaking of the longevity, can you give us some success rates, or have there been more failure rates?
Yeah, all of the data that I'm probably going to share is really focused on success rates, because we've seen candidly nothing but significant success in our programs. And that's not to say that there aren't captive programs across the country that have not succeeded, but I would say that those that have not succeeded are because the work wasn't done up front to really get those members to understand what they were committing to and what they were part of, right? But when we look at our programs, for example, I'll share some stats from the last 2 years of our largest heterogeneous program that both McGohan Brabender and Scott Insurance have significant amount of members in. Over the last 2 years, 85% of our members in the program have seen their costs come in under budget. And not just by a little bit, but by an average of over $1,200 per employee per year. Okay.
Wow.
So that's a significant amount, right? If it's a 100 employee group, right, on average, they're seeing $120,000, under budget performance, and that's money obviously that can be well spent. At the same time, our captive as a group, and talking about that opportunity to win when we perform well and return dividend, has performed equally well. Our 2-year loss ratio is 83%. So what does that mean? It means that 17 cents of every dollar that we're pooling together for these large claims is coming back to the members in the form of a dividend. In total, over the last 2 years, that was $3.2 million returned. So some pretty significant, numbers in regards to financial success. And I think we see that mirrored, across our programs that are administered, with the same intentionality in regards to accountability and risk management.
Mm-hmm. And I think, Pim, I've heard you say this before, and, if you've seen one captive, you've seen one captive. And so oftentimes we'll hear about other captive programs, and people will assume that our captive program is the same or similar. And although there are some underlying similarities, I do think that there are many significant differences, many of which you have highlighted here, and we appreciate that so much. Thanks for sharing those statistics. And maybe one last statistic you could share is, what's the renewal rate of clients that go into a captive? I know we said earlier, hey, one of the benefits is you can exit if you need to, right? This is a quote unquote short-term proposition if you need to exit for business purposes or otherwise. The idea is that you would enter into this for the long term, right? Putting the we before the me. But what is the persistency of groups inside of the captive?
Yeah, and the captives that we're involved in, and I want to state that these statistics really come from the captives, right? That we're involved in because of the the educational impact, obviously, in the preparation that goes into getting people ready to come in. But our retention rates are over 95%, so very, very high, and that even includes sometimes we help clients get so successful, right, that they become a target acquisition of an acquisition target. They are selling to either a competitor being bought, acquired. Private equity comes in, right? These are companies generally that are very well run, and they've used captive as a very appropriate strategy. So some of that retention, and some of the folks that we've seen leave have not left by choice, or that the captive hasn't been the right solution for them, right? It's just their business environment has changed. So we're really proud of that. And that's a number we want to be really focused on, because if we have a client that joins a captive and wants to leave, chances are we haven't done, our due diligence up front and really help prepare them for what to expect.
So, Pim, how large can these programs get? Because I know we discussed that they can break up into multiple programs, maybe based on size.
Yeah, that's a really good question. And the reality is that how large they get probably in great measure is determined by who's running or influencing the captive and what their goals and objectives are. So there are some very large captives in the country operating today that have thousands of members in them. But it's my perspective and my personal philosophy around captives that if you have thousands of members without accountability and without collaboration with each other, that all you've really done is created another insurance company, right? Joining a program like that, basically, you may as well stay fully insured with a Blue Cross or a Anthem or a United, Cigna, et cetera, and just operate in the same large pool that you always have, because that's essentially what it becomes. So my perspective on it is that captives should only grow to the point where the members can feel the collaboration, feel the connectivity, feel the opportunity to really work together and determine the course of how the captive operates. Once you reach that threshold, in my opinion, it's time to break up a captive into multiple what we call cells or groups, that operate, and what that number is. If your follow-up question might be is, well, what do you think that number is? My gut tells me that it varies, and it does vary by program, but probably as you get into the 75, 80, 90 employee size, employer membership range is probably at that point when you start to look and say, hey, there's probably some diminishing returns here between the value that the larger pool creates versus the loss of kind of the collaboration.
Right. Makes sense. So this question we wanted to know, and it ties into what we were talking about earlier with the ACA being 11 years old. So what surprised you in the most in the last 10 years, if you had to pick one thing that surprised you the most? Just one.
I'll be honest with you. I'm continually surprised by how difficult it can be to get very well educated employers to leave a fully insured structure that they can't possibly believe really serves them or their employees any longer. Maybe that's a strong statement, but the reality of it is that most of our members that join reach a tipping point where the light bulb goes off and they see that an insurance company does not share the same goals and objectives as they do as a client of that insurance company. And that by joining a captive, you can align yourself with the goals and objectives of a lot of other good employers. And so throwing your hat into the ring with other employers that that you trust, that have the same values as you, that are struggling with the same challenges, is something that ultimately I think defines when people make that switch. But yeah, it shocks me all the time how hard we have to work and how often we have to sometimes tell the story before a company is ready to break away from the traditional model.
Yep, that's
Right.
a good one. I would agree with you. So well said.
that was the past. And if we are looking into the future, if you were to have a crystal ball, where do you think the future of captives is going?
Yeah, I think that the future of captives is going to obviously continue to be growth. But I do think that one of the things that we are going to see in that growth is more growth along the lines of industry captives or association-based captives. That I think that folks are starting to understand that the collaboration that they enjoy sometimes within industry groups, within other affiliations, are things that they can build off of with a captive structure as well too. So I think that we are going to see more activity in that space. A great example of that is that we recently have been working with the National Center for Employee Ownership to develop and launch their first health insurance captive program, which is focused exclusively on supporting the employee-owned community. And so we're really excited to be part of that. Employee-owned companies are excited about the ability to not just collaborate on health insurance issues, but also to have a real tie to collaborate with other employee-owned companies. So that's just a very specific example of where I think we're going to continue to see growth in the captive space.
So, Pim, if you had one thing to leave our listeners with, anything at all that you'd like to say about captives, that employer that's on the fence, the one that's got that hard head and not thinking like you just gave us that answer, what's the one thing you'd like to leave our listeners with?
Yeah, I think the one thing that I would say is take a look at historically, right, who your best partners have been in business, and evaluate what those core relationship values are, and then take a look at what your relationship looks like with your current insurance provider, whether you're fully insured or whether you're self-insured with a reinsurer, and try to identify if there are any of those values, any of those things that you want to be focused on that are shared in common with those providers. And if not, give captives a real hard look, because in my mind, right, that's really the key. Moving to an environment where you have transparency, where you have collaboration, where you have trust, is just so important. And for most companies, it becomes such a breath of fresh air once they move into that type of a model and see what it can do for their business and for their employees.
Well, Pim, thank you so much. I say sign me up. And unfortunately, that's all the time we have. But thank you so much for joining us today and sharing all of your knowledge and expertise on captives.
It's been my pleasure. Thanks for having me.
And if anyone has any other questions or comments about this podcast, we'll have Pim's contact information on our website. And you can email me at kenzie@healthierbirthdays.com.
Or you can reach me at ann@healthierbirthdays.com.
Thank you so much for joining us, and we'll see you next time on Side Effects.